Nobody can tell you the exact date of the next stock market collapse. It's not written on any calendar. The market won't announce it in advance. But here's what most people don't understand. That date can be narrowed down quietly, methodically, long before panic ever shows up. Right now, markets look calm. Stocks are near record highs. Most people believe the danger has already passed. Yet the most important signal isn't in prices. It's not in headlines. It's hidden inside liquidity, inside the behavior of banks, and inside the timing of those who are exiting while others are still buying. The last two times this exact pattern appeared, investors were confident until they weren't. By the end of this analysis, the question won't be if a collapse comes. It will be whether the warning was recognized before the date became obvious. This type of analysis is structured, calm, and rooted in pattern recognition. The exact date of the next stock market collapse isn't written on a calendar, but the conditions that lead to it always follow the same pattern. This pattern has appeared again, quietly, while attention has been pulled elsewhere. People are watching headlines. They're watching technology hype. They're not watching liquidity, and that's where everything is about to change. The Federal Reserve has already restarted money creation, not as a future policy, not as a discussion point, but as an active operation. Roughly $40 billion per month is now being injected into the financial system. This isn't described as quantitative easing, but the effect is the same. The central bank is expanding its balance sheet again after 2 years of tightening. That shift alone changes the entire market environment. The reason this matters isn't optimism. It's stress. Bank reserves have fallen to multi-year lows. Emergency lending facilities have seen record usage. In simple terms, banks have been running short on usable cash. When this happens, the system becomes fragile. The central bank doesn't act because conditions are strong. It acts because something is close to breaking. This detail is often missed because markets usually rise when money is printed. Prices go up, confidence returns, and risk appears rewarded. But the cause of the printing matters more than the result. To understand why this matters, you need to understand how banks actually work. When a person deposits money into a bank, that money doesn't sit idle. It's lent out almost immediately. The depositor still sees a balance on a screen, but the physical cash has moved elsewhere. This creates more spending power in the system than originally existed. This structure is called fractional reserve banking. Since 2020, banks in the United States have effectively been allowed to operate with zero required reserves. That means every deposited dollar can be lent out. The system functions only as long as most depositors don't ask for their money at the same time. When confidence breaks, withdrawals accelerate, assets must be sold quickly, and losses appear. This is how modern bank failures occur. Recent history has already provided an example. In 2023, a major U.S. bank collapsed within days when depositors lost confidence. Bonds were sold at losses. Information spread instantly. Liquidity disappeared. The system required emergency support. That event didn't end the story. It exposed the structure. When the Federal Reserve injects money into banks, it stabilizes reserves and reduces immediate risk. But the new money doesn't stay idle. It flows outward. It looks for return. It pushes into stocks, real estate, and speculative assets. This is why markets often rally when liquidity increases, even if the economy underneath is weakening. This is where the next phase begins, and what happens next will surprise you. Rising asset prices create confidence. Confidence creates demand. Demand creates opportunity for insiders to sell. This is when initial public offerings appear, not one or two, but many, and often at the same time. This isn't coincidence, it's timing. Founders and early investors aren't emotional participants. They're rational. They sell when prices are high and when buyers are abundant. They don't sell when conditions are uncertain. They wait for liquidity, optimism, and excitement. These conditions are forming again right now. The market has seen this pattern before. In the late 1990s, liquidity was strong and optimism was extreme. Hundreds of companies went public in a single year. Many had no profits. Valuations were justified by new narratives. When liquidity tightened, the market collapsed. The technology index lost nearly 80% of its value. The same pattern appeared again in 2020 and 2021. Massive money creation lifted asset prices. A wave of public listings followed. Retail investors rushed in. Within 2 years, most of those investments were deeply negative. The IPO wave didn't follow the crash. It marked the peak. Today, another IPO wave is forming. Large private companies with ambitious valuations are preparing to go public within a narrow time window. Many are tied to a single theme. Many are priced far above historical norms. This doesn't mean they're bad businesses. It means timing is critical. The Federal Reserve's actions connect directly to this behavior. Liquidity creates conditions where selling is easy. When insiders begin to sell, they transfer risk to the public. This isn't unethical, it's structural. The system rewards those who exit early when conditions are favorable. The key point isn't fear, it's sequence. First comes economic stress, then liquidity support, then asset inflation, then insider selling, then reversal. The crash doesn't happen at the moment of fear. It happens after confidence peaks. This is why the exact date is never announced. It emerges after the final stage is complete. Those who understand the pattern don't panic. They observe. They reduce exposure when risk is highest, not when prices are already falling. The story isn't about predicting tomorrow. It's about recognizing where the system stands today. Liquidity has returned. Optimism is rising. Exit doors are opening. History suggests that this phase doesn't last indefinitely. It ends suddenly, after most participants believe the danger has passed. But what happens when liquidity begins to change behavior is something most people never see coming. At this stage, markets are no longer responding to fundamentals. They're responding to flow. Money enters the system faster than it can be absorbed by productive activity, so it moves into assets that already exist. Stocks rise, not because earnings justify them, but because capital needs somewhere to go. In this environment, risk becomes invisible. Volatility declines. Corrections are shallow. Every dip is bought quickly. This creates the illusion that the system has become safer, when in reality, it has become more fragile. Stability built on constant liquidity isn't stability at all, it's dependency. The business community often misreads this phase. They see strong equity markets and assume economic strength. But underneath, borrowing costs, leverage, and balance sheet mismatches continue to grow. Companies refinance, banks extend credit, investors increase exposure, the system stretches quietly. At the same time, narratives begin to dominate decision-making. A single theme becomes the explanation for everything. In past cycles, it was the internet. Later, it was disruption. More recently, it has been artificial intelligence and scale. These narratives aren't false, but they're incomplete. They explain potential, not price. As prices rise, valuation discipline erodes. Multiples expand. Revenue projections extend further into the future. Risk is justified by growth that hasn't yet occurred. This is when capital becomes impatient. It wants access now, not later. This is when private companies move toward public markets. Initial public offerings aren't random events. They're strategic exits. They cluster when liquidity is high and buyers are confident. This clustering isn't driven by innovation cycles. It's driven by financial conditions. When money is abundant, markets are willing to absorb supply. This is the moment when retail participation increases. Individuals see rising prices and feel urgency. They don't want to miss the next opportunity. Media coverage reinforces this urgency. Success stories dominate. Failures are ignored. Risk is reframed as courage. Meanwhile, professional capital behaves differently. Institutions reduce marginal risk. Insiders prepare liquidity events. Lockup agreements are signed. Timelines are established. These details rarely matter to the public until months later. The system now enters a narrow corridor. It can continue higher for longer than expected. Liquidity can sustain optimism. Prices can detach further from fundamentals. This is why calling the peak too early is costly. Timing matters more than direction. However, certain signals begin to appear consistently at this stage, and they're already showing up. Emergency lending remains elevated, even as markets rise. This is a warning. It suggests that liquidity is supporting asset prices, but not resolving structural stress. Banks are stable because support exists, not because risk has disappeared. At the same time, the composition of market gains changes. Fewer stocks drive more of the index. Breadth narrows. Defensive assets begin to outperform quietly. Long-duration assets become sensitive to small changes in expectations. These shifts are subtle, but they repeat across cycles. Another signal is the behavior of insiders. Share sales increase after lockups expire. Secondary offerings appear. Private equity firms accelerate exits. These actions are rational. They reflect opportunity, not panic. But collectively, they shift risk outward. The public often interprets this as confidence. Large offerings are seen as validation. High valuations are seen as proof of demand. But demand created by liquidity isn't the same as demand created by income. One persists, the other fades quickly. As this phase progresses, the system becomes highly sensitive to policy changes. Small shifts in interest rate expectations, inflation data, or political outcomes carry outsized impact. The margin for error narrows. The system can absorb good news easily, but bad news compounds. This is where the illusion of control peaks. Participants believe risks are understood and managed. Models show stability. Historical volatility looks low, but the future is being priced using assumptions formed during extraordinary conditions. The most important insight at this stage is that crashes don't begin with selling. They begin with exhaustion. Liquidity stops accelerating. New buyers slow. Marginal demand weakens. Prices may still rise, but momentum fades. The public rarely notices this transition. It feels like a pause, a consolidation. But for those watching flows rather than headlines, it marks the end of expansion. From here, the system requires either more liquidity or a reset. History shows that more liquidity can delay the outcome, but it cannot remove it. The imbalance grows larger. The eventual adjustment becomes sharper. This is why the timing of exits matters more than the belief in long-term potential. This isn't about fear, it's about comfort. And comfort in markets has always been the most expensive emotion. The pattern is visible. The sequence is predictable. What remains uncertain isn't whether the adjustment will come, but whether participants recognize the warning while exits are still available. What follows next isn't a sudden break, but something far more deceptive. Prices may still be high. Headlines may still sound confident, yet something subtle changes beneath the surface. Liquidity no longer feels abundant. It still exists, but it no longer expands fast enough to cover every risk that's accumulated. At this point, the system begins to reveal its true dependency. Markets are no longer rising because new capital is entering aggressively. They're rising because selling pressure hasn't yet arrived in force. This distinction matters. A market supported by buying is strong. A market supported by the absence of selling is fragile. Businesses start to feel this shift before investors do. Access to cheap credit becomes uneven. Strong companies still borrow easily, but weaker balance sheets face higher scrutiny. Banks quietly tighten standards. Even if policy rates appear stable, this tightening is rarely announced. It shows up in rejected loans, delayed financing, and shorter maturities. Inside companies preparing to go public, urgency increases. Timelines that once seemed flexible become fixed. Advisors push to move faster. Valuation discussions focus less on long-term vision and more on current demand. The goal is no longer perfection, it's completion. This urgency isn't driven by fear of failure, it's driven by awareness that conditions don't last. Meanwhile, public investors begin to experience something confusing. Markets no longer react positively to good news in the same way. Earnings beats result in muted responses. Strong economic data triggers concern rather than optimism. Every positive signal carries the question of what it means for policy support. This is where confidence begins to fracture, not collapse. People still believe in the story, but they no longer trust the timing. They hold positions, but they hesitate to add more. Trading volume changes character. Long-term investors become less active. Short-term traders become more dominant. This increases volatility even if index levels remain elevated. The structure of ownership also changes quietly. Early insiders whose selling was once locked now have the ability to exit. They don't sell all at once. They sell methodically. Small amounts spread over time. The selling doesn't crash the market. It caps it. It absorbs demand that would otherwise push prices higher. Retail participants often misread this. They see sideways movement and assume consolidation before another rally. They look for catalysts. They wait for confirmation. But confirmation never arrives in the expected form. Instead, markets become sensitive to unexpected events. At this stage, the system is vulnerable to shocks that would have been ignored earlier. A policy misstep, a geopolitical event, a credit accident, none of these need to be large. They only need to interrupt confidence temporarily. When that happens, selling pressure appears suddenly, not gradually. And the reason why will shock you. The reason is leverage. During periods of easy money, leverage builds across the system. It exists in portfolios, in corporate balance sheets, and in financial products. Leverage magnifies gains on the way up, but it forces selling on the way down. When prices fall below certain levels, positions must be reduced regardless of belief or conviction. This is why market declines accelerate so quickly once they begin. It's not because everyone changes their mind at the same time. It's because the system removes choice. Risk management rules activate. Margin requirements increase. Liquidity evaporates. For the business community, this is the most dangerous moment. Decisions made under stable conditions are suddenly tested under stress. Expansion plans are paused. Hiring slows, mergers are reconsidered, cash becomes more valuable than growth. Those who prepared earlier behave differently. They're not immune to losses, but they're not forced sellers. They have liquidity when others need it most. They can wait while others must act. Importantly, this moment doesn't feel dramatic at first. It feels disappointing. Expectations are revised downward. Targets are missed slightly. Analysts adjust forecasts. The language remains calm, but beneath that calm, the system is adjusting rapidly. The public often asks why crashes feel sudden. The answer is that the conditions were built slowly, but the trigger was small. When confidence depends on continuous support, interruption matters more than magnitude. This is also where narratives change. The same stories that justified high valuations are questioned. Growth projections are revisited. Risks that were dismissed become central. The market doesn't abandon the future. It reprices it. This movement isn't about collapse. It's about exposure. It reveals who relied on conditions remaining favorable and who planned for change. It separates belief from preparation. And by the time this separation becomes visible to everyone, the most important decisions have already been made quietly, long before the headlines reflect them. By the time the shift becomes obvious to the broader public, the system is no longer deciding what might happen. It's deciding how far the adjustment must go. Markets at this point aren't driven by new information, but by the repricing of assumptions that were formed when liquidity felt permanent. What follows is often misunderstood, and it's already beginning. People expect panic first, then falling prices. In reality, prices fall first and panic arrives later. The initial decline is usually rational. Valuations compress, risk premiums widen, investors reassess what they're willing to pay for uncertain future growth. This phase feels controlled. Many believe it will pass quickly, but control is an illusion when leverage is involved. As prices move lower, pressure spreads across interconnected parts of the system. Hedge funds reduce exposure. Banks reassess collateral. Market makers widen spreads. Liquidity, which once felt endless, becomes selective. It still exists, but only for those who don't need it urgently. This is where forced behavior begins to dominate voluntary behavior. Selling is no longer a choice for everyone. Some must sell to meet obligations. Others sell to avoid becoming forced sellers later. The result is a feedback loop that accelerates declines even when no new negative news appears. For businesses, this environment changes priorities overnight. Cash flow matters more than growth projections. Balance sheet strength matters more than vision. Companies that expanded aggressively during easy conditions now face refinancing at worse terms, or not at all. Projects that made sense when capital was cheap are quietly shelved. This is also when the gap between quality and speculation becomes impossible to ignore. Strong companies decline, but weak ones collapse. Access to capital becomes the dividing line. Those who relied on continuous funding discover that markets are no longer willing to wait. Public perception shifts rapidly at this point. The same commentators who dismissed risk now explain why the outcome was inevitable. Confidence turns into hindsight. Many ask why they weren't warned, even though the signals were visible months earlier. The idea of an exact date becomes emotionally important here. People want a moment to blame, a single decision or announcement. But markets don't work that way. The date isn't the cause, it's the result. It marks the moment when accumulated imbalances can no longer be sustained. Historically, this moment often aligns with a convergence of events rather than a single trigger. Liquidity support slows or stops. Insider selling peaks. Political uncertainty rises. Economic data weakens just enough to change expectations. None of these alone caused the downturn. Together, they remove the final layer of confidence. At this stage, policy responses are expected. Central banks are watched closely. Governments signal support. But policy operates with delay. Markets move faster than decisions. Even when support eventually arrives, prices may already reflect damage done. This is where opportunity and danger coexist, and the irony of what happens next is striking. For those unprepared, losses feel permanent. For those who maintain discipline, the environment becomes favorable. Assets that were unreachable months earlier begin to trade at rational prices. Risk becomes priced again. The irony is that this is the healthiest part of the cycle, even though it feels the worst. Excess is removed. Weak structures fail. Capital reallocates toward productivity rather than speculation, but this benefit is only available to those who survive the transition. The final realization is uncomfortable but necessary. Crashes aren't anomalies, they're structural resets. They occur not because markets are broken, but because they were pushed beyond balance. Liquidity delayed the adjustment, but it also magnified it. Those who understand this don't ask when the next crash will happen in emotional terms. They ask where the system is vulnerable and how exposed they are when conditions change. They focus less on prediction and more on positioning. The exact date, when it arrives, will feel obvious in hindsight. By then, portfolios will already reflect decisions made earlier, either wisely or impulsively, and the market won't reward awareness at that moment. It will reward preparation that came before it. That's the quiet truth behind every major downturn. The outcome is decided long before the event. The only uncertainty is who recognizes it in time, and who realizes it only after the adjustment is complete. The signal was always there, hidden not in secrecy, but in plain sight, visible to those who chose to watch liquidity instead of headlines, to those who understood that crashes don't announce themselves. They arrive after confidence peaks, after exits close, after preparation time has passed. The exact date was never the question that mattered. The question was always who saw the pattern and who acted on it before the calendar made it undeniable. What are you seeing in your market right now? What signals are appearing locally that align with this pattern? Because economic pressure doesn't move uniformly. Your perspective adds context to this conversation. The next phase of this cycle won't wait for permission. It will simply unfold, and those who understand the mechanics will navigate it differently than those who only react to outcomes. The most important decisions are always made before the moment arrives, not during it. When liquidity begins to shift again, when the warning signals become unmistakable to everyone, the exits will already be crowded. The best positions will already be taken. The adjustments will already be complete. That's why understanding the pattern matters more than predicting a specific date. The system operates in cycles. Each cycle follows the same structure. Liquidity expands, confidence builds, risk transfers, conditions tighten, adjustments occur, the variables change, the names change, the narratives change, but the sequence remains consistent. Those who prepare during stability benefit during stress. Those who chase during excitement suffer during adjustment. This isn't about pessimism, it's about structure. Markets reward awareness, not reaction. They reward those who recognize where conditions stand, not those who wait for confirmation. Right now, the system is signaling clearly. Liquidity has returned. Optimism is building. Insider exits are forming. The sequence is progressing exactly as it has before. The question isn't whether this pattern will complete. The question is whether you'll recognize it before the completion becomes obvious to everyone else.